Hi everyone, welcome to episode 76 of the Startup Playbook Podcast. My name is Rohit Bhargava, and each week I interview successful founders, investors, and subject matter experts on how they got started, the strategies they use to succeed, and their advice to current and future entrepreneurs. Welcome back to the podcast in 2018, and as you may have noticed, I took a slightly longer break than I was expecting from the podcast, and just wanted to quickly fill you in on what's been happening. First of all, in case you missed the announcement at the end of last year, my business partner at Playbook Media, Adir Schiffman, and I are bringing down the San Francisco-based B2B SaaS accelerator program, Accelerprise, to Australia. The program will invest $75,000 into some of the best B2B SaaS companies in the country, providing them with access to chief executives and decision makers within large corporates, as well as access to some of the best mentors in Australia and abroad. The companies will also get to spend 1 month in the US working alongside the US cohort, pitching at the US Demo Day, and being provided with intros to US companies and investors. If you or someone you know is running an interesting B2B SaaS startup, I would love to chat with you. Shoot me an email at rohit@startupplaybook.co if you would like to find out more about the program. Also, although I haven't been recording podcasts, I've been busy creating content. As some of you may know, prior to the podcast and Playbook Media, I was the co-founder and CEO of Stage Label, a crowdfunding for fashion platform that helped launch and grow over 150 e-commerce brands globally. Through Playbook Media and my time with Stage Label, I've had lots of experience in building and growing online businesses. I've put together a book called The E-Commerce Playbook, which compiles over 100 strategies, hacks, and tips, as well as 50 case studies of successful e-commerce brands from around the world. The book will be published in April, but you can sign up to get access to the pre-release for the book. I'll add a link to the pre-release in the show notes for this episode, which will be available at startupplaybook.co. So coming back to episode 76, my guest for this podcast interview is Dan Gavel, the director of Black Sheep Capital, an early-stage investment firm that invests in companies across seed, angel, and Series A opportunities. Black Sheep Capital is one of Australia's most active early-stage investment firms, having invested in 25 startups in 3 years, including companies such as Airtasker, Sendle, and Practice Ignition. What makes Black Sheep Capital unique is that the funds behind the firm come directly from Daniel and his business partner Paul Osborne and follow a service-oriented approach, helping their portfolio with company structure, refining metrics, and future fundraising. In this interview, we talk about understanding risk capacity, why founders need to be comfortable with change, Black Sheep's investment due diligence process, how founders can prepare for investment, and the importance of warm intros. Without further ado, here is my interview with Dan Gavel. Hi, Dan. Welcome to the Startup Playbook Podcast, and thanks so much for taking the time to be on the show today.
Not a problem, mate. Happy to be here.
So for those people that may not be as familiar with you or your background, do you want to share a little bit about your story and what got you here today?
Sure. Well, Dan from Black Sheep Capital. We're a professional angel, probably in that we do angel-style investments, but we have a structure and a team behind us, which is often something that angel investors don't have. Black Sheep actually came about following my 10 odd years as a financial planner. My now business partner, Paul Osborne, and I, we were, looking at the end of my financial planning career. The industry was changing. It was getting harder and harder to provide quality advice at a reasonable price. And we went from being client advisor relationship to being very close friends. And over, the space of a couple of months, we started to talk about, well, what's the future for both of us? And off the back of a whole lot of conversations, we decided that we would both kind of sell up our assets and combine to start Black Sheep Capital. It started as a quasi family office. So we do invest in a broader range of investments than just tech, but we've built like a team, and my focus is just on the tech investments at the moment. Right now, I think we've been operating for about 4 years, and we're at the point now where we think that it's all taking off for us.
Fantastic. So, I'm always curious to know where people sort of come from and how that leads into particular things. But I guess from your experience in financial planning, what are some of the characteristics or lessons that you learned in terms of the investments that you make, and also does that shape at all the startups that you look at?
Oh, 100%. I guess the easiest way to put it is my financial planning background taught me risk, and risk. in that I have a good understanding that everyone and every situation you can have a different capacity for risk, and understanding how you can apply that and utilize it in your own comfort zone has been a massive lead to what we do at Black Sheep Capital. Risk can be in a lot of different ways in the tech space, particularly, the risk of if you're managing someone else's money can impact the decisions you make around investments compared to when it's your own. It's easier for me to take a risk because it's my own money and my business partner's money at stake, as opposed to if you're managing another stakeholder's capital. My learning in risk came reasonably early on in my financial planning career, because right as I became a fully fledged financial planner, there was a big global event called the Global Financial Crisis. I spent a lot of time on the phone talking to customers around how their risk profile had affected their overall situation. And it shaped really a lot to do with my understanding and capacity for risk now. Arguably, probably have too high a propensity for risk now, but in a way I think that's probably a good thing as a tech investor.
Yeah, you would assume that, I guess coming from a financial planning background, I assume where it's about, how do you sort of manage your risk, there wouldn't, you wouldn't see a stronger correlation between let's now jump into sort of venture capital. But how do you sort of think of and approach risk yourself, considering that you put your own money into the investments?
I think all risk decisions should be made around understanding what you're comfortable to lose, understanding your position, your overall portfolio, and factoring that into everything. Like any good investor, venture capital isn't the only investment we have. It's a portion of a portfolio where we've decided we can take a higher risk metric because we understand the overall impact of it on our portfolio. I presume as time goes by, when we get more runs on the board, then the risk capacity will change again, because you have the runs on the board, you have the ability to take high risk because you've already backed good companies, and it allows you to be more risky in what you take. But risk is just I don't think there's this, I guess there's the risk that an investment is, and a risk that you're prepared to take and still maintain your longer term goals. I think you've got to be cognizant of both at the same time. And it's a tricky thing, the market's changing, personal situations changing, always plays into it, but it's long term, and that's the view we take. The cliche, there'll be some winners and there'll be some losers. And in the early days, we've been particularly lucky that we have made some good investments, and that already changes the sort of risks that we're happy to take.
Absolutely. I think your point about understanding risk from the perspective of what you're prepared to lose is something that's often overlooked, obviously from an investment perspective. But for myself as a founder, I remember when I was telling my friends that I was quitting my engineering job and leaving to start a fashion tech company, they were, talking about, I'm absolutely crazy to take these risks and all of these sort of things. But from my perspective, it was, if this works out, obviously there's a financial upside, I get to do what I enjoy. But the downside was that, if it didn't work out, which it didn't after 3 years, but, I was in a position to get, I was so much further in my career. I was being offered jobs that I wouldn't have been offered otherwise, on pay that I wouldn't have been offered otherwise. So for me, there was literally no risk, was the way that I perceived it. But from everyone else's perspective, I was the craziest person in the world to leave the cushion of a decent paying job.
Oh, 100%. And, I went through exactly the same thing. When I was a financial planner, I had a very solid financial planning business. I was paying the bills, living a nice life, went on a holiday every year, kind of had a good client base. But in leaving, I had to go probably exactly what you went through, where you think about what's the fallback position, what's the upside, what is objectives around risk, particularly in your personal situation, aren't always based around financial reward. For me, the opportunity to get into a new style of work, the biggest attraction to me, which I think will probably impact me in the future, is I couldn't be an employee again, because now that I've been a business owner, I think I'd be a terrible employee.
So true.
And I think that when I looked at it, I always looked at what's the fallback position, and the fallback position was I could go back to being a financial planner. And like you say, is there much risk in that? The biggest risk is you're 2 or 3 years out of the market, might impact your ability to go straight back in, but you pick things up pretty quickly. And at the end of the day, I think that risk, when calculated and understood, is for a certain type of person, is something you can be very comfortable with. Like we take risks all the time. Every time, I started early with risks, like traveling through Asia or that sort of stuff. I think we have a high capacity for risk, and I think that made it easier to want to drive and go into an industry I'd never tried before, but always calculated. Risk, we have very calculated process behind risk.
Absolutely. And is that something that you look for in the founders that you're talking to and backing, in terms of the way that they approach risk and their sort of calculated nature of doing so?
Yeah, it's funny. It's I think so. And again, risk starts with understanding your personal situation. I think founders know that certain companies are going to be riskier than others, certain industries and certain stages are going to be a lot more risky. But there's always risk in a business, and I think, like you say, it comes down to an understanding of it. And often, I wouldn't say risk can be overlooked if you understand it, but risk can be managed if you have process behind dealing with it. We look for founders who have high capacity for change, high inductive and verbal reasoning. So when difficult and what maybe otherwise described as risky situations come along, they have the right process and the right mindset behind dealing with it. And being open to talking to the people in your network, your advisors, your investors about it, I think to a large degree you can manage out a lot of risks, or at least have a strategy behind dealing with it.
Sure. In terms of a founder's ability to manage change, do you think that that's something that's innately true to that person, or do you think that that's something that you can teach to someone?
It definitely helps if it's inherent. I think that you could try and teach someone about change, but we would prefer to look for someone that has vision, and change comes from vision, right? And an acceptance that things could be done differently to get a different result. I think you could teach it, but I think it would be more difficult to do than someone who inherently is comfortable with it.
Sure. And so, to my understanding, Black Sheep invests from seed to Series A?
Sure. We've invested everything from a $25,000 check into $1 million plus.
Sure. Are there sort of, I guess, what are the differences between when you're writing a $25,000 check versus, say, $1 million check? Are there different things that you look for and that you sort of focus on?
Sure. I think in the early stages, very early on, look, and we actually built a process behind this. It's founder. The one constant is the founder. Like we were talking about before we had this conversation, in your fashion business, the one constant was you. You went through different strategies, you went through different staff members around you, but the one constant is the founder. And a good founder will be able to build a good business, whether it's what you invest in or what it becomes. And most businesses are going to change along the way anyway. So in the initial stages, it's the founder. And we looked at that so much so that we actually engaged a professional org psych who to help us build a process to understand founders better before we invest. In the later stages, when the C-suite team is deeper, the strategy's more set, it's more about growth capital than validation capital. Sure, you probably less focused on the founder. You still want to invest in the highest quality of founder, but there's a higher element on trying to a greater focus put on what the business can become with the capital you're putting in, as opposed to very early stage you can invest in the business, but we've all seen it. Businesses can become very different from particularly from seed to Series A and B.
Absolutely, and oftentimes when speaking about what a good founder, what are the characteristics of a good founder, that can be very subjective, from person to person and meeting to meeting.
Sure.
that you have. But I guess, what are some of the things that you look for in a founder who may be a first-time founder, for example, that to you would demonstrate that they're they're high quality?
Yeah, like I touched on it before, but like a high capacity for verbal and inductive reasoning. Starting a business is complex, particularly for a first-time business owner. You've got HR difficulties, revenue difficulties. There's a lot of things you have to be able to take in, absorb, action, and it's a high learning curve. It's a very steep learning curve. That is a major focus for us. I think, while it's not kind of as measurable, I think someone who we see we can work with over a longer period of time, call it a Friday lunch rule, where, if I don't think I can sit down and have a Friday lunch with you, the likelihood of a long-term relationship working out is particularly low. We look for vision as well, like the ability to see beyond what the company is now to what it can become. And also someone who we can see who there's a very big difference between someone who is an early stage founder to someone running a post Series B and C company. So we want to see someone who we feel can either go through that or recognize when there's a time that someone else needs to come in and take over.
Sure. Do you have obviously this will vary depending on the business, but do you have a rough process that you go through from, say, the first time that you meet a founder to, I guess, the term sheet being handed out? Sure.
So we actually have two very distinct sides of due diligence, one on the business and one on the founder. The founder being as we said, the core. We want to know more about you and their capacity to become like a successful entrepreneur. So we focus very heavily on understanding more about them, their motivations, the way they approach businesses, the way they approach problems, and to the point where we've built like a fairly good structure behind understanding that. From a business standpoint, sure, there's metrics we look for. We look for businesses that we can help. We look for founders we can work with. To be completely upfront, we like businesses that have some revenue, that have some customers, not overly like set on pre-seed. For the right pre-seed in the right industry, if we could be useful, definitely. And then again, it just depends on the stage, because we've invested from seed to Series A. You can be more thorough in your Series A business due diligence, the standard markets, go like what market they're operating in, addressable markets, just the standard stuff. Probably a lot of other people probably said it before, but we don't look for anything majorly different. We're looking more into like the tech capacity, how the team operates together, how they engage with founders, all that sort of stuff, which comes just from a lot of conversations. We do try not to get into analysis paralysis. I think that's very much a risk in our industry. You can keep going in circles and talking yourself into and out of. I think one of the core rules we have, a very core rule for our investment process is the moment we feel like we're trying to talk ourselves into an investment as opposed to out of it, we walk away. And that's a very strict rule for us. Yeah.
So obviously you've got a really clear process that you sort of go through, and there, as with anything, there are so many different variables that have to come together for you to make a particular decision. But are there any particular red flags that you screen for that become an immediate no, even if you're interested in the business or think that the founder is potentially a great founder?
Yeah, and look, it's learned over time. There's a lot of things, and I guess it's circumstantial as well, but I think there can be a tendency a big one is people who focus too much on the product and not on the business. It's one thing to build an amazing product, but if you haven't understood the use case, or you don't understand the people you're selling it to or your ideal client, and you haven't started to apply that to how you're growing the product is affecting your metrics, your business metrics, that's a big concern for us, because we feel like you need to understand both sides of the business. Like, clearly product is very important, but understanding the business is very important as well. we at certain stages, governance is important, but really it's case by case, because if you're blown away by the founder and you believe that they can turn the business into something, then a lot of the other stuff can be ironed out. Like we have processes where we can help with get the metrics under wraps, help them understand unit economics, but you really have to understand both sides, I think, to turn a business into something legitimate, or a product into a legitimate business.
Absolutely. And in terms of, so Black Sheep is industry agnostic?
Yes.
Yeah. So how do you, look at or compare different opportunities from different industries at different stages? And then I guess from your perspective, like what is it that makes you want to jump in on a deal?
Yeah, look, at the heart of a lot of our investment decisions is the, would we use it ourselves? Like, is it a product as someone who's owned small businesses or, has used a lot of tech solutions, would we use it ourselves? Use case is a big one, like if we can see that it's solving a real problem, irrespective of some of the gimmicky sort of things that get added into pitch decks at the moment. If it's solving a real problem for real businesses and we could see future or current engagement, that's a big signal for us. Things we understand, like we're not chasing, crazy right now futuristic technology. We effectively just want to invest in businesses that make other businesses better. That can be in a range of different ways, profitability, efficiency, effectiveness, just simplifying sort of processes. We like things that add significant value as well, aren't just like a little add-on to something that's already in place, and something with a clear line of sight to engagement from its customer base.
Sure. I guess something that you touched on a couple of times in this interview was how you focus on the need to add value to the person. I noticed on your website as well that's a huge sort of emphasis and focus for you. So I guess something that's often overlooked from a startup perspective when looking at an investment is just the money that they're getting and not thinking about who they're partnering up with, and potentially why an investor isn't deciding to say no, even though their business might be a great business and might have a lot of potential. Can you explain a little bit about why being able to add value beyond just the investment side is important for you and for Black Sheep? Sure.
Money isn't the solution to all problems. We feel like the more we've invested, the more of the belief that it's critical for us to be able to get in and add that value. And value can be created in a range of different ways. It's not just adding, like being able to introduce to clients, of course, is very important, but we work very hard on helping with boards, providing services around HR, leadership training, future round preparation, like preparing data rooms, a lot of the standard stuff. But for us, when again coming back to the risk, do you invest in something where you basically have to put your money in and sit back and see what happens, or do you feel more comfortable in something you can get hands on, you can help them develop their product, their sales process, all those sorts of things? And we've just made a conscious decision that we feel more comfortable working with companies where we can be value add. And it's hard, but we turn away companies which, perhaps everyone will have a story at some point around how they missed that one. But we feel comfortable because right now our attitude towards risk is that we want to work with companies we can help, and we try and do it every day. We try and find new ways to help our companies and add value.
Absolutely. So again, something that we spoke about just before we turned on the mic was, again, for something that's often overlooked from the funding perspective is that the best companies and backable companies are often things that the investors have to try and convince the founder to go with them. For someone who's in the situation where they've got sort of, multiple different opportunities on the table in terms of funding or different aspects of sort of going about that, what are some of the things that they should look for when deciding which fund or which investor they should jump in with?
Sure. I mean, it's the same as we would call a customer, to see how they've engaged with the startup. You should ask other people, like talk to the startups in the portfolio, ask them how they engage, ask them, and it's dual. Like in some case, in the case you're talking about, it's a privileged position to be in the space where your company is that sought after that you can have a choice option. It comes back to that, can you work with this person over the longer term? It can come down to who's, like, often it's a terms-based thing, and a control element. We're very win-win, try to be founder-friendly in our terms where we can. It can come down to that. Do you want someone who's going to have voting rights, board rights, decision rights? Is that, because whenever you take money, the company's no longer yours. It's everybody's. Some people are going to want to have more say than others. It really just comes down to a comfort thing. As much as we want to be comfortable with the potential of a founder, and a business, a founder should want to be comfortable with the investors they're going with, because this is it can be 5 to 7 years you're going to be working together, and it's a long road. You want to be with someone who will both hold your hand and be strict, or not strict, but let you know when things aren't going well, but you want someone that's going to do it in the right way.
Sure. I guess historically there's been a lot of stories about people taking on funding from angels or from different sources on fairly bad terms, and that negatively affecting their ability to get follow-on investment. Again, I guess just curious, especially I guess from some of the more Series A investments that you take on, or even just looking at companies that have had raised a prior round before coming to you. What are some of the things that people should consider or really know about when it comes to the terms that they take on for funding?
Yeah, I think there's something to be said about, and I don't know, like for the early stages, it's difficult because a lot of the information you need to get comes back to a cost metric, like to get a solicitor to look over documents costs money, to understand all that. But from day one, and this is from even before you've taken investment, if there's two founders from day one, understanding your legal documentation and the impact it has on your business and can have on your business is one of the most critical things I can suggest to a founder. It's not something that can be, and this tracks back to my financial planning days. I've seen business divorces. Like, I've seen how messy it gets when you don't have the right structures in place. And then understanding that moving into your future rounds and how it impacts them. From an angel round to a Series A, I would say that it's your angel who should be actually help walking you through this, and because they're the ones who are setting what impact the terms they take will have on the next round. There's also an element of, and as I guess this is pretty honest, the previous round doesn't mean much if the next investor can just come in and go, well, these are my terms. We've seen not unfair terms, but what could be seen as like investor-friendly terms get washed away at Series A because the Series A investor says, well, they go or we don't invest. But it's critical to understand liquidation preference shares, understand anti-dilution clauses, understand like the impact of veto rights. Understand, it's often overlooked, but I think it's critical to understand because it does have an impact. Like a liquidation preference share in a Series A can be very impactful on someone coming in on a Series B. I think probably another big overlooked one is when high valuations, then you often worth it taken. I know you want to get the best because it makes you feel good if you raise at 10 million, but your metrics you have to hit to get your next round can often be blown out and makes it very difficult to negotiate future rounds if your valuation on the one before was already high. And there's plenty of things you can do in legal structuring to make it comfortable for everyone. But it's a time and a place thing, like often I'm sure there's been plenty of cases where needed the money, and the person with the money in some cases has all the control. but you're completely right though. You need to think ahead of these things. We try and coach our startups when they're looking at the next round of the impact of what that can mean. But it's difficult because founders often have, and as a common industry problem, founders often have very different objectives to investors, particularly venture capital, when they have stakeholders and fiduciary responsibilities to the people whose money they're investing.
Absolutely. On that, I guess one thing that obviously there's a huge amount of focus on how do I get an investor to give me a term sheet and get their money, but what happens after that relationship has been established and the startup takes on the funding, and what are some of the responsibilities and things like that startup founders need to consider? Sure.
Like we talked about it before, and it's interesting, I think there's two very distinct sides to tech investing, and that's one, we call it venture capital as a service. I think it's a term that kind of comes out of the Andreessen Horowitz and some of the bigger US firms, in that for us particularly, we see the investments, the initial investment, like due diligence, setting the terms, that's 3 months. 3 months to get from introduction, sort of on the long side, 3 months to get from initial introduction to investment. But it's the 5 to 7 years after that really counts. So we in a way see ourselves as just as much a services business as an investment business. The quality of the relationship and the outcome for both sides post investment, it all comes down to communication. Up front, we try and communicate what startups can expect from us and what we expect from startups, and clearly communicating that can set a platform for the relationship moving forward. You can't help someone if they're not telling you what's going on. We help in many different ways. Our portfolio is quite broad, as across industry and stage, in that different startups are going to need different things at different times. Sometimes they need mine and my business partner's experience with negotiating with corporates or introductions. Sometimes they need our analysts and our associates to get in and help them develop addressable market understandings, help them develop budgets and forecasts, help them develop go-to-market strategies, sales processes. It's different for everyone, but I think the core is what we try to get across to our startups is we're there for you. We don't want to get in and run the business, but we want them to know that the helping hand is there if they need it. We call it active but not implementive, needs-based investing or services sort of thing. But like any business, we have finite resources and we try and do our best to manage that. But arguably, the further the startup goes along, the less they need from us. They get to the point where their teams are deep enough that they're not going to need human resourcing assistance from us. Strategically, they've got C-suites and advisors and boards that probably don't need our assistance so much. But then we work very closely with all our startups where we can, and the whole basis of it is being open, honest, and communicating.
Yeah, on that point, it's very hard for someone to help you if they don't know what you need help with. And often, it just goes back to your earlier point about, not just taking funding from someone just because they've got the money, but because they can help. And if you can develop that relationship with someone and make them feel comfortable enough to know that, it's not just about the money and they're there to help, and it's in both of your interests to build a business. It's just getting onto that same page and communicating.
Well, and everyone wants, once you've invested, you want, founders, the worst thing you could have them do is feel like they feel isolated from their investors, because if you let those scenarios get too out of hand, it just gets more and more difficult, and it's a learning, I think everyone tailors their engagement approach over time. Ours every week gets better. We get a greater understanding of what our founders are looking for, and help's not always an introduction or someone from my team. Help can just often be how do I deal with this investor? How do I deal with this board member? How do I deal with working 70 hours, trying to keep up relationships with friends and stuff, because we've all been there. I think it's about knowing that you can be that person they can turn to, particularly as an angel. When you go from angel to Series A, when you get venture capital money and different institutional sort of money, often they need that investor they feel like still on their side, because, as I say, like the objectives change, the responsibilities change as you go up the tree from the types of investors you take it from. But they've all got a time and a place, and everyone needs to be able to really get along for the company to work and to get the best outcome for everyone. But at the end of the day, our philosophy is it's win-win for everyone. Like, it's a zero-sum game for us. Like, we want everyone to get an outcome, but we want it to be done in the right way. Like, we don't want relationships to be painful. We don't want people to feel like we're stepping on their toes, but we want them to feel like that if they need a shoulder to lean on, that we're there for them, and that can be in many different ways.
Yeah. I think it was Adrian Stone who sent out a tweet. This was like over a year ago. But he sent out a tweet saying that during his Angel Cube days, he'd made 60 plus investments at that time, and he'd received 2 quarterly reports from all of those investments. From a I guess a reporting perspective and from an investor perspective, what would you like to see from the companies?
I don't want like a thesis of 60 pages every time, every quarter or every month, but it's hard to, like you touched on before, it's hard to help if you don't know what's going on, and it's crazy to believe when the communication cuts off and the reports get less, that it's not recognizing that things may not be going as well as you want them to be going. Really, like, the more you can give to a point, board reporting is different to investor reporting, and there's definitely at different investment stages, you have to be very cognizant that different investors and get different levels of reporting than others. But biggest things are how you're going. Like, the metrics are one thing, but I tell you the number one thing which I would like to see more from the industry in general is, at the end of the report, how can I help? What are the 3 things I'm struggling with? Because all the numbers aside, that's what really matters. Like, you can't help with a problem, as you say, unless you know what it is, and you can't make introductions, or you can't help a startup unless they're giving you some guidance. The numbers in that are kind of like very important as well, because you want to be able to, I report back to my business partner on how our startups are going. But at the end of the day, the most important thing is, what are you struggling with and what can we help you with, And it doesn't always have to be in the form of a report. We actually provide to the startups that want access to a reporting platform which is fairly automated, and they don't have to pay for it. As long as the information is going in, we can almost do our own reports. We get so much more out of just sitting down on a monthly, 2-monthly, quarterly basis with our founders and just looking them in the eye and having a conversation. To me, that sort of interaction is far more important than getting a 2-page document every 3 months. Having said that, it'd be great to get a quarterly report. Like, I wouldn't complain. But I also understand for founders, it can be quite time consuming, because often reports lead to questions, particularly around board reports. Just again, this comes back to open and honest communication. Like, if revenue's struggling, if your cash balance is going down, just tell me, just be open with this.
Yeah. So obviously these are the companies that you've already invested in, but I guess one of the harder aspects for companies that are looking to fundraise is, how do you develop relationships and how do you maintain contact, and where is it appropriate to update and not update a potential investor. So again, from that perspective of I guess someone who is looking to engage with you or build a relationship with you, sure, what would you like to see?
The earlier the better. I feel like it's not too late if you've already got a pitch deck and stuff like that, but you'll have much more chance of getting investment if we've known you for a longer period of time. And it's super cliche, I know, but warm introductions do matter. They're not the end of the world. Like, we have invested in companies that came directly to us, but you do, and warm can mean a number of things. Like, I'm not saying be introduced by my best friend or but be introduced by another investor. Like, try and find us at a networking event, just do more than just an email which says, I've got the greatest idea in the world, you should give me money. You have no connection to it then, and it's no secret, like, it's easy to see who we're invested in. It's easy to find someone in, like, it's not that hard, but it's also not completely necessary. I would rather a startup came to me, they've just raised seed, pre-seed. They go, we're looking at this great idea. I'd love to put you on our investor updates over the next 6 to 9 months so you can get a feel for it, so we can know you're hitting targets. I feel like that's a much stronger process than just, here you go, here's a pitch deck. I have no connection to that pitch deck or that company, so it's much harder because you have to blow me away with that pitch deck. And as you can understand, we get a lot of contact around, hey, let's get together for a chat. But the unfortunate reality is, by the time we look through all the pitch decks, meet with our current startups, manage our portfolio, all that, you just cannot meet with everybody. So to give yourself some sort of edge, whether it be from a warm contact or starting the relationship pre-funding, and we have a list of startups we're following, just so when they're ready for funding, we'll know by that time if it's something we're interested in. We give them feedback. We say, this is what we would like to see. No is not always no. No could be not the right time. We want to see this, you build out this, and this. We'd love to see you hit those targets. And there's nothing better in an investor's standpoint than sending out an investor report that says, we were going to do this and we did. We were going to build out this part of the feature. We were going to hit this revenue. We were going to get 3 pilots, whatever it is. Execution. He asked earlier, what's something that we like when we look for execution is something we're very heavy on, and realism. Don't tell me you're going to be $1 billion company in a year and a half if it's unreasonable, but show me you can execute on your business plan and on what you're trying to do, and that's extremely impressive to us.
Sure. On the warm intro stuff as well, because again, this is something that we spoke about before we turned on the mic, but it's essentially a screening tool as well. I'm sure you're inundated with pitch decks and emails and all of those things, but for someone that is in your network to provide an introduction to you to a company means that they've put their own reputation on the line to provide that introduction, which is a pretty strong signaling tool if you trust that person's intro. So again, from a perspective, it isn't just that this is a friend that's passing something to you.
Yeah.
This is something that comes with a level of trust that makes it, I imagine, a bit more immediate for you to focus on.
Sure, definitely, and happy to put this one out here, but I'm implementing a rule this year that anything that comes from a warm intro, any introduction, I'm going to take a meeting for. It's something I hadn't done previously, but that's partly wanting to understand more, to your point, understanding more about what the people in our network look for and the sort of companies and founders they're working for, as well as giving people a clear sign that you'll get that far if you actually put the effort in. And you're 100% right. This goes that concept of the warm introduction goes beyond just, startup founder to investor. For our portfolio companies, when we introduce them to potential clients, when we introduce them to potential mentors, advisors, as you say, if someone is willing to put their reputation on the line to introduce you, because you put something, not something bad, but you put something which you're just for the sake of putting through, the likelihood of it, the next one being looked at with any significant sort of thought process or respect behind it minimizes. And look, again, it comes from my financial planning days as well. When I would refer a client to an accountant or a lawyer, you're not going to refer a problematic client, are you? Because otherwise it doesn't work both ways. You want the validation to happen because you want people to be sending you sensible stuff, not wasting your time.
Yeah. Absolutely. So, I guess for any early stage startup that is looking to build relationships with founders, the recommendation is start as early as possible and find a warm intro.
Yeah, look, the warm intro is one thing, but the most basic way to say it is don't make the first contact to be about the raise. Just something as simple as, hey, I'm starting to put together a regular investor report. Can I send it through to you? Can I put you on my mailing list? Don't ever just put me on the mailing list without asking, because I just don't like that. But do that. That's as good as a warm introduction, because I'm starting to get to know you before we start thinking about the investment side of things, and I'm not going to tell people how to find warm introductions, but it's pretty easy these days to do some Google research and stuff like that. It may take time to actually get to know other people to get to know us, but I mean, the industry is big but relatively small in Australia at the same time. If people were smart, they might message you.
Yeah, well, we spoke again about sort of signaling things around the way that people respond to certain things as well. But also similarly, if you can't hustle your way to find a warm intro to the person that you want, what are your chances of trying to get into a large corporate or an enterprise when you're trying to sell? It's all translatable skills across different things.
And look, the hustle element's one thing, but I would take that a step further, and it's about understanding who, call it a power sponsor or just a sponsor. It's about understanding who the right person to speak to is. I think a lot of people can get in the door to hustle and get you in, but it's no good hustling you to get an interview with a CEO if it's the CFO who makes the decision and the CEO has absolutely no outcome from that meeting. Yeah. I think that's a common mistake as well, is just thinking about it's getting in the door the right way as opposed to and with the right person as opposed to just getting in the door, but it's so wide, we've had people get in contact with some of our founders to be able to get to us, to connections on LinkedIn. If you're serious, you'll find a way. And I'll be honest and say only one investment in our portfolio came from a direct contact. And it just happened that was a good investment for us, but the rest have come one way or another through either. And that founder came because they did the research to see we'd invested in businesses and contacted me and said, pretty much, I don't have a warm intro, but I see you've invested in this. I think we're in a similar space. I'd love to have a chat. And it made sense. So either find a good rationale. And I think that's a big part as well, is not just getting an introduction, but understanding if we are the right investor. Because again, we talked about it before. There's things that we just won't touch because it's not in our skills base, or we can't add value, and I think being cognizant of that. And I always think it's risky for someone to write to us and go, I think we're the perfect fit for you, when you look at our portfolio and you see we've not invested in anything like that before. Take the time. It's like if you're going for, and I know it's hard to say because there's lists out there now where you can just get every investor's email in Australia and flick it on. That's both good and bad. It's bad because it's good because it means you're contactable and everyone but it makes it too easy, and I think in one way, you want people to do the research and understand if you are the right investor or not. And if you have, we've had people and didn't end up investing, but people made really savvy plays in going, we looked at it, we know you like this sort of founder and this sort of product and this industry, we think you'd be worth a chat. They got a chat, didn't necessarily get investment, but they took the time to understand us. And it seems like less of a waste of time because they've at least done their own pre-vetting to know that we could be the right investor.
Yeah, absolutely. But direct reach out can work out because we're doing this interview because I messaged you on LinkedIn.
Right, but to be fair, I had been contacted by someone else to say that you might be contacting me.
Oh, really?
Yeah.
Okay.
Yeah, another investor, so a warm intro.
There you go. I didn't even know about that. So I guess from an ecosystem perspective, I know, again, this is something that we sort of touched on this morning, but what would you like to see more of in Australia from your perspective as an early stage investor?
I think that we personally are going to be focusing on forming closer relationships with other investors, like other investors who we feel are like-minded to us, who want to invest in similar sort of similar spaces, similar sorts of stages and things like that. Because some of our best experiences have been working with investors who have that similar mindset, who don't fight against each other, who are willing to be open about process and knowledge and like coming back to that win-win. Don't see it as us versus them mentality. Collaboration, I think, across the board, like we're trying to actively get, and I know some of the VCs and stuff do this already, get their startups to collaborate more, because if one startup's been through an issue, then guaranteed someone else in the portfolio has been through the same thing. And taking that further, I know we talked about it before, that extends beyond just what people see generally as the ecosystem as startups and investors, but we're talking, I would take it further and go governments, like all that could do a better job of collaborating across the board to get a greater outcome for Australia. And I think that's the way that the industry as a whole will move forward. I think that we've come ahead in leaps and bounds. But for us, it's collaboration and process for us as well. Like, we're pretty open about sharing our process with other people, like other investors and stuff, because we want to work more closely with people. We want our startups to do better. We want the industry to do better. And I think that for us, that's the focus, and that's what I'd like to see the industry focus on as well. And just, I guess, like getting to a level of just professionalism across the board from startups and investors. Like, I think that we're behind in some things, like, coming back to the quarterly reporting and stuff. Like, I don't think we should be aiming to be San Francisco, but there's also like better ways to be preparing yourself and your startups to get capital, to get clients, and that starts around having a more professional approach.
Fantastic. And what are you excited by for the coming year?
Oh, look, I'm excited that I think we'll start to see some real progress across the board in just some big wins for Australian tech companies. Personally, I'm for Black Sheep Capital, I'm really excited to see the platform and the internal strategies that we've been working on over the last year starting to take shape. Starting to see the benefits of having a different approach to working with our startups to what we had originally, and really just excited in general, mate. I think 2017 was a growth year for a lot of people across the board. I think there was a lot of learnings that people will take away and use to really push forward in 2018. And we're one of them. Like, we've got a long list of things we want to implement, different things we want to try. And honestly, I'm excited every day to go to work. So I don't think there's anything in particular. Like, I just love being in the role that I do, and I love working, like we talked about off like Mike before, in that we work in an industry where every day we learn. We've got people to learn from, new knowledge to absorb, and I think it's like, because I'm permanently excited, I think it's hard to say I'm excited about anything in particular. I'm excited just to continue learning and growing in what is an exciting industry.
Absolutely. It's hard not to be excited when you're in the space, I feel.
Oh, 100%, and it's great because we've had learnings along the way, and like, I think it's an industry where you constantly can get wins, and wins aren't always like big raises or capital or big clients. Wins can just be learnings, and because we work with such a broad group of people, I think it astounds me, the quality of people in the industry. And again, and the diversity of backgrounds, I think, is something that I find really attractive about it, because you just see the left field thinking that you get, the different way people approach things. I think it makes it exciting to be in such a dynamic space that that, I guess it's just the job is exciting in general, so it makes it fun going to work every day.
Absolutely. On that note, Dan, thanks so much for coming on the show and sharing your experiences and insights. I'm not going to ask you how people can get in touch because they should find a warm intro, but I know you do a fair bit of content as well in terms of what you guys look for at Black Sheep. So if anyone wants to find out more about Black Sheep or look at some of your content or things like that, what's the best way for them to do that?
Look, LinkedIn, Twitter, all those normal sort of ways. Medium we post on as well. But also don't forget that I'm not the only person that works in Black Sheep Capital. We've got an analyst and an associate, and I've got a business partner who are all very active, and we try and maintain a fairly flat hierarchy at Black Sheep. So if you could get just as far by contacting and getting in touch with Dan or Roshni at an event or through their networks as well. Don't ever think that you have to come straight to one of the partners. Those guys are equally important to the business and are equally as capable of deciding who we shouldn't meet with and look into further.
Fantastic. I'll make sure all those links are in the show notes. Dan, once again, thanks for your time.
Thanks, mate. It's great to be here.
Cheers. Thanks for listening to episode 76 of the Startup Playbook Podcast. You can find the show notes of my interview with Dan, along with a curated list of tools and resources for startup founders at startupplaybook.co. As always, you can join the conversation through our Twitter account. The handle is @PlaybookStartup. Don't forget to subscribe to stay up to date with our latest episodes. Thank you for listening, and I'll see you at episode 77 next week.